Economists have noted that the world economy is subject to synchronized cycles in asset prices, leverages, and capital flow, which they think of as a global financial cycle. One variable that is very prominently correlated with this cycle is the US dollar exchange rate. The dollar appreciates when global risk appetite falls, when there's a flight to safety or a panic in markets, when global financial conditions tighten, for example, tighter monetary policy by the Fed. But global financial conditions go beyond monetary policy of the U.S. Even when U.S. monetary policy is relatively tight, other financial conditions may not be as tight. To some extent, the global financial cycle really is a global dollar cycle. The factors which drive the financial cycle also drive the dollar, and the dollar has a global impact due to its unique global role. Of course, the dollar can be thought of in some sense as the world's currency because of its roles as a invoice currency, a funding currency, a vehicle currency, an anchor currency, and a reserve currency. Since the middle of 2021, we have been in a persistent appreciation phase of the dollar. I'll say more about this at the end. And right now, we're experiencing and expect an intensification of a slowdown in global activity as the Fed tightens, as other central banks tighten, and as the dollar appreciates. When the dollar strengthens, global commodity prices tend to fall in real terms. When the dollar strengthens, the growth of world trade volume declines. These correlations tend to imply that dollar strength is bad news for emerging and developing economies, particularly, indeed, for the world economy, but particularly for middle and lower income economies. Why are emerging markets particularly vulnerable to a strong dollar? Well, a number of factors have been isolated in the literature. For many countries, weaker institutions, including weaker, less reliable policy frameworks, weaker transmission of monetary policy through the markets, greater rigidities in markets, broader poverty, shallower and more distorted financial markets, a prevalence of dollar-denominated liabilities. This was dubbed original sin by Eichen, Green, and Hausman in 1999 in a famous paper. And while emerging market sovereigns have increasingly moved to denominate sovereign debts in domestic currencies rather than dollars or euros, corporates in the private sector borrow very heavily in key currencies, particularly in dollars. So they're vulnerable to an appreciation of the dollar, which raises the domestic value of their liabilities. There's also vulnerability to capital flow reversals. Agustin Carstens and Yun-Sung Shin at the BIS have called this phenomenon original sin redux. And it's the idea that when the US, say, raises interest rates, this will cause interest rates to rise in emerging markets. It will cause their currencies to depreciate. And so investors from industrial economies will have very strong incentives to pull money out of emerging economies when interest rates rise, say in the US or the Eurozone, and this is something we are seeing at the moment. We learned that both short and long-term interest differentials appreciate the dollar. So when dollar interest rates at short or long-term rise relative to foreign countries, the dollar strengthens. Treasury liquidity strengthens the dollar. Excess bond premium of Gilchrist and Sarachek is associated with dollar strength. So when lenders to American corporations become more reluctant to lend, when their risk appetite declines, the dollar tends to strengthen. And this is a very consistent and strong correlation. We find that our exchange rate equations have a considerably stronger in-sample fit than you might expect, and especially after the global financial crisis. You can appreciate that explaining the movements in exchange rates is hard, just as explaining the movements in stock prices is hard, even with contemporaneous data. Given the importance of this Gilchrist and Sarachek excess bond premium, we repeated our earlier exercise to look at the effects on emerging market macro and financial variables. And what we find is that a tightening in this premium leads to a very deep and protracted fall in real GDP and investment, deep deflation, terms of trade deterioration, falls in equity prices that are very persistent, and a large increase in the policy rate of interest. So this driver of the dollar seems to be a particularly powerful negative force for emerging markets. It strengthened sharply in the panic of the spring of 2020 as the pandemic emerged, and you can see that here. Then as the Fed rolled out massive monetary stimulus, it fell, reaching a bottom in the middle of 2021. But long before the Fed started hiking interest rates in March of 2022, the dollar was already on the rise because it was obvious that the U.S. was recovering faster than the rest of the world, and the Fed would have to raise interest rates sooner than other industrial countries, which indeed was the case. Emerging markets, however, saw the problems coming and began hiking already in the middle of 2021, and this includes Korea, of course. This chart is a bit out of date because the tightening cycle has been proceeding apace. But what you can see is that very, very few advanced economies hiked on the left-hand side in 2021, shown in orange, compared with emerging markets. But there have been big hikes shown in green in 2022, and the hikes in the emerging markets have continued. The situation is one where there's a massive global impulse for tightening, which could set off a massive recession if it continues at the current pace. Inflation will come down, but inflation is partly driven by supply shocks, including the effect starting in February, March 2022 from the Ukraine war. But even before that war, food prices had been rising and energy prices had been rising very sharply. The war made things worse. Now, one danger in this scenario is that jointly, if there is no attempt to cooperate, the world central banks will create a worse recession than is actually needed to bring inflation back to target. when the Fed hikes its interest rates and other countries suffer depreciation of their currencies, that raises their import prices and worsens inflation. And this might lead them to hike interest rates even more. In effect, emerging and developing economies suffer both from the tightening of financial conditions and from importing inflation due to the dollar's strength. This is also true to some extent in the advanced economies, but emerging markets generally, because of their weaknesses, their fragilities, are much more vulnerable to the effects of financial tightening and the effects of domestic currency depreciation and higher interest rates. What is needed here, I think, is for central banks to communicate clearly with each other and to take even more account than they normally would of the actions of central banks abroad and of the reactions to their own policies. Another measure that could be very useful would be a greater extension of swap lines to emerging markets. Emerging markets could intervene in the foreign exchange market, not just emerging markets. Japan has been doing this. But in doing so, they could use up precious reserves that they may need later. In that sense, the swap lines would be very, very useful. And Korea is a country that has benefited from these in the past, and especially benefited during the global financial crisis. And I'll wrap up. Korea has benefited quite a lot in the spring of 2020 and after. It benefited during the global financial crisis. And this is one way that international cooperation could help if richer countries would extend swap lines to a broader set of emerging markets than they have done in the past. Also, the position of the IMF is critical, and countries could help themselves by taking greater advantage of the liquidity facilities that the IMF has created, particularly as a result of the crisis.
Asian financial system, despite the efforts, the Asian investors actually invest in assets in dollar-denominated assets, and then they are a lot of liabilities are now held in the local currency denominated, but it actually makes it could actually make the Asian financial assets or financial markets vulnerable or exposed to unwinding or carry trade like original sin redux. So at the end, let me just give some summaries and then also the policy implication. Financial cycle can when the financial cycle turns, it can actually hurt the emerging market borrowers. It could trigger capital flight and then pose the risk to financial stability. During the periods of the financial distress arising from high U.S. dollar funding costs, as Professor Opsfeld also mentioned, many non-U.S. global banks may be forced to curtail lending to emerging market economy. That is really part of the original sin redux story. And the regions of policymakers should remain vigilant against the financial turmoil. And lastly, so this is why we are all here. Why is the financial cooperation important for the region? Development of the local currency bond market is one initiative, very important initiative by the ASEAN+3 economies during at the in the aftermath of the Asian financial crisis. It should still continue, and we should actually promote the more faster the development and then of the local institutional investor that could really invest in the local currency assets rather than still invest in dollar assets. And the policy coordination is important. As Professor Oswell also mentioned, that the region does have the regional financial safety nets, with the Chiang Mai Initiative Multilateralization, CMIM, and then the MRO, which work as the independent regional surveillance unit.
As many of you already know about the global economy, since the last 70s or 80s, the global economy has been as heavily depending on the economic growth based on the techno-economic innovation, such as the semiconductor industries or the automobile industry. And I would like to say that the semiconductor industry is one of the powerful growth engine for the global economy. But many of you knows that the global economy at the crop. So we can talk about there will be worldwide the semiconductor trade decreased from the $1.7 trillion to $1.4 trillion. And there will be additional cost rises from the $170 billion to $250 billion yearly for the China. And most of the key players is involving US, South Korea, and Taiwan will suffer the severe cost spikes. And this will bring us the impact and the sequences, such as reorganization of global value chain of semiconductor industry, which will result in the spike in overall cost. And this will increase in the prices of all of the chips. And it means that there will be halt in the IT-driven innovation, such as we can expect that there will be some cost increases in the artificial intelligence or data-driven industry or deep tech industries. And it means that the economic growth in focusing on this IT-driven innovation will be slowed down. And it means that there will be recession and given by this slowed down growth. So let me just conclude my discussion that there will be some heavier impact given by the U.S. and China's techno-economic crisis and the conflict in nowadays. And this conflict will result in the overall decrease in efficiencies and the overall increase in the cost for the global semiconductor industry. And to recover the global cooperation in this semiconductor industry, we need to take some lessons from the formation of the strong the cooperation network between the companies and between the nations. And the Korea's strategy to take this impact should be based on the open ecosystem and the intensive investment in research and development